All right, strap yourselves in because today we're going deep on this guy, Keith Gill.
Oh, yeah, this is going to be good. Roaring Kitty. Remember him?
You know, the dude at the center of that whole GameStop short squeeze back in 21.
Wild times, man. Wild times.
Well, you guys sent us a ton of stuff on him, articles, research, even some personal stories.
People want to know, right? Is this guy a Wall Street whiz kid or did he just get lucky?
Yeah, like, is he a grifter or is he gifted? That's what we're going to figure out.
So we got news articles, opinions from all sides, and even some stuff on how companies are dealing with the fallout from what he did.
So to get this, we got to understand how a regular guy like him became, like, the face of this whole Wall Street rebellion. He wasn't some fancy hedge fund hotshot, right?
Oh, no, not at all. Gill's backstory is actually pretty wild. Like, he was a track star, and a financial advisor from this small town. Back in 2010, he was just analyzing stocks for his friend's software company.
Okay, so he's been interested in the market for a while. But how'd he go from that to, like, igniting one of the craziest market events ever?
Well, in 2018, Gill decided to put his money where his mouth was. He put $53,000 of his own savings into GameStop.
Whoa, $53,000. That's a big gamble. GameStop wasn't exactly the hottest stock then.
No, not really. It was trading at like $5 a share. People thought they were done for. But Gill, he saw something different. He thought they were totally undervalued, especially with the new gaming consoles coming out.
So he saw potential in what everyone else thought was a dying company.
Yep. He did his research and was convinced the market was wrong. And man, was he right. By January 2021, GameStop stock was at, get this, $483 a share.
Hold up. From $5 to $483. That's insane. But how much of that was his smarts and how much was just, right place, right time?
That's the question, isn't it? Skill or luck? Here's the thing. He didn't just buy the stock and chill. He was building this whole online persona, Roaring Kitty, putting out his GameStop analysis on YouTube and Reddit.
Okay, now things are getting spicy. He's publicly pushing GameStop. Was this just some passionate investor or was it, like, calculated?
Well, people started paying attention. Some saw him as this everyday guy who knew more than the Wall Street suits. It was David versus Goliath.
Yeah, the little guy taking on the big guys.
Exactly. And as more people jumped on the GameStop train, the price just kept going up, and that's what they call a short squeeze.
Wait, back up. For those of us who don't speak Wall Street, what's a short squeeze?
Okay, so short selling is when investors borrow shares of a stock they think is going to tank, sell it, then buy it back later at a lower price, and pocket the difference.
So they're betting against the company.
Right. But when a stock goes up instead of down, those short sellers get squeezed. They have to buy back the shares at a way higher price to cut their losses, and that buying frenzy can make the price explode, which is what happened with GameStop.
So Gill, with his Roaring Kitty hype and this short squeeze thing, that's what sent the stock to the moon.
Basically, yeah. But of course, all this caught the eye of the regulators. In February 2021, Gill gets called to testify before Congress about his role in all this.
Whoa, congressional hearings. That's serious stuff. What happened there?
Well, Gill said he was just sharing his own opinions based on public information. He wasn't giving financial advice, never told anyone to buy or sell. He was just like super bullish on GameStop.
So he's saying, hey, I just like video games and think this company's cool. Not my fault, what other people do.
Yeah, pretty much. Didn't stop him from getting sued, though. Someone filed a lawsuit saying he committed securities fraud, though it got thrown out eventually.
Hold on, securities fraud. What's it? Why was he accused of that?
Simply put, it's when someone lies to investors to mess with stock prices. This lawsuit said Gill was pumping up GameStop on purpose, knowing his followers would buy in.
So the big question is,
Yeah.
was he genuinely sharing his thoughts? Or was he trying to manipulate the market to make a buck? I mean, the lawsuit got dismissed, but it still makes you wonder, right?
Oh, yeah, for sure. And that's where this whole grifter or gifted thing gets tricky. There's stuff that supports both sides. Was he just some random investor who got lucky? Or was he playing a deeper game?
Well, it sounds like we need to really dissect his analysis of GameStop to get a clearer picture.
So let's break down what Gill actually saw in GameStop. Why was he so bullish when everyone else was like, game over, man?
Right, because he didn't just pull this out of thin air.
No way. He thought Wall Street was missing the bigger picture with GameStop. He saw value in their brand, their loyal customers, their stores, the whole thing.
So he wasn't buying into the whole digital downloads and streaming will kill physical games thing.
Nope. He said physical games still matter, especially for serious gamers, collectors, that crowd.
Yeah, I get that. I still like having the actual disc sometimes.
Right. And Gill thought GameStop could actually make the shift to digital, too.
But hold on, weren't they, like, struggling big time back then? Their stock was in the basement for a reason.
Oh, they definitely had problems, no question. But Gill thought that low price was an opportunity. He thought a turnaround was possible.
So, classic value investing. Find a good company that's down on its luck.
Exactly. He thought the market was too focused on the short-term issues and not seeing the long game. Now, whether he was totally right about that, that's debatable. Some analysts think he was too optimistic about GameStop's ability to adapt.
So even if his overall idea was flawed, maybe he was still a good analyst, just wrong about this one.
Could be. He definitely did his research. But here's where it gets tricky. His whole online persona, Roaring Kitty, and all that social media stuff.
Right, because even if his analysis was solid, you could say that constantly pushing GameStop, especially at all those online followers, maybe that crossed the line from sharing info to, like, manipulating the market.
Totally. And that's what makes this grifter or gifted question so hard. Was he trying to teach people, or was he hyping the stock to get rich?
Tough call. I mean, maybe he was just super passionate about GameStop and wanted others to get on board.
Like a true believer spreading the gospel.
Exactly. But he made a ton of money when the stock exploded. Hard to ignore that, right?
Yeah, hard to say it wasn't a factor. And this whole Roaring Kitty character, that adds another layer to this.
It's kind of brilliant marketing, though, right? This funny, relatable character, people connect with that. It's like Wall Street meets a wrestling show.
Right. It's entertaining, it grabs your attention, but it also makes you wonder, was Roaring Kitty all an act? Was it just to get followers and pump up GameStop?
And think about when he came back online in 24, he posts this weird sketch, everyone freaks out trying to figure it out, and bam, GameStop stock jumps again. Too perfect, almost.
It does make you think. Was that just random timing, or was he playing the market again?
Okay, so even if we're generous and say his original GameStop investment was legit, this social media stuff is sketchier. It's like he knows he can move the market with a single post.
Yeah, it brings up ethical questions about influencers and finance.
Because it's not just free speech anymore, right? When you can influence millions of people, maybe move billions of dollars, it's a whole different ballgame.
Definitely. And that leads to the bigger question. What does all this mean for the future of investing?
So beyond grifter or gifted, what are the lessons here? What does this say about online investing and how anyone can be a market mover now?
One big thing is that the lines are blurring between entertainment, information, and manipulation.
It's not as simple as it used to be. Just because someone has a big online following doesn't mean they know what they're talking about, right?
Exactly. You got to be careful with online info, do your own research, understand the risks.
So don't just trust what you see on Reddit or YouTube.
Right. Social media can be a good starting point, but you got to dig deeper before investing your money.
And there's a difference between sharing info and giving financial advice.
Huge difference. Just because someone made bank on a stock doesn't mean you will too.
What else should we watch out for?
Anyone promising guaranteed returns or saying they'll make you rich fast.
If it sounds too good to be true.
It probably is. Smart investing is about managing risk, not getting rich quick.
So what's the takeaway here?
In a world where everyone's trying to grab your attention and maybe your money, you got to think for yourself. Do your research, be careful what you believe, and don't let your emotions take over.
And remember, investing is about building a secure future, not about jumping on the latest online trend.
Well put. The Roaring Kitty story shows that even with online investing, the basics still matter. Do your homework, manage your risk, be independent.
So as you navigate the world of investing, keep these lessons in mind. Stay informed, stay sharp, and always ask yourself, grifter or gifted? So we covered a lot of ground here. Gill's background, his GameStop thesis, how he became this, like, Wall Street folk hero.
Or, maybe a villain, depending on how you see it.
Right, exactly. It's not a simple answer, is it? Grifter or gifted?
He definitely knew his stuff, but that online persona, all the hype he created, it's kind of sus.
Yeah, and that's the big takeaway for anyone listening, right? Roaring Kitty shows how important it is to, like, think for yourself, especially when it comes to investing. So how do we not get caught up in the hype? How do we tell the real deal from the con artists in this crazy online investing world?
First thing, be skeptical. Don't just believe someone because they have a bunch of followers and sound really sure of themselves.
Do your own research.
Absolutely. Look into the company, their financials, what their business is all about. Find some independent analysis from people you can trust.
So not just Reddit and YouTube, huh?
They can be helpful, but don't base your decisions on that. You got to dig deeper before you invest your hard-earned cash.
And, like, just because someone made a ton of money on a stock doesn't mean you will, right? That's not real advice.
Nope, not at all. Big difference between sharing info and giving actual financial advice. Always keep that in mind.
What else should we watch out for? Red flags like,
Anyone who says they can guarantee returns or make you rich quick, run the other way.
if it sounds too good to be true.
It probably is. Real investing, it's about managing risk, making smart choices, not winning the lottery overnight.
So what's the main point here?
The main point is, with all the noise and chaos online, you got to think critically. Do your homework, question everything, and don't let emotions drive your decisions.
And remember, investing is about building a strong financial future, not chasing the latest online craze.
Couldn't have said it better myself. The Roaring Kitty story is a good reminder that even online, the basics of investing still apply. Due diligence, risk management, thinking independently, that's what matters.
So as you guys continue your investing journey, keep these lessons in mind. Stay informed, stay sharp, and always ask yourself, grifter or gifted?
Great advice. And that's a wrap on this deep dive. Thanks for joining us, everyone. Until next time, happy investing.